This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
It's my pleasure to welcome Jason Franciosa to the show. I had the pleasure of having dinner with him and some other friends a few weeks ago at the Capitalism Conference in Dallas, Texas. I was a speaker at that conference. After Jason saw my talk, he was bringing up some of the issues of monetary policy, inflation, and things like that. I just love this topic. It is my absolute passion. He is a former military officer. His business partners are all veterans, as is he, and he's very passionate about helping veterans achieve financial independence. He has an Amazon business where they sell CrossFit gear as well. It's just a pleasure to have him on the show. Jason, welcome. How are you?
Doing well. Thanks, Jason. Thank you for having me on the show.
Hey, I hope people can keep track because we have two Jasons here.
Yeah, exactly.
It's almost as confusing as the way the Treasury, the government, and the Federal Reserve operate.
Yeah, exactly.
Yeah,
you can never follow along.
Absolutely. So we hope you can follow along. What got you interested in the things behind monetary policy and how it affects investments and the time value of money?
To be honest, it's just fascinating. I mean, it is amazing how everything correlates with each other and how most people don't even understand the fundamentals. You know, they think, oh, if I just had a bunch of cash in my bank account, I'd be wealthy. Well, yeah, maybe today you'll be wealthy, but in the very near future, that money could be literally worth next to nothing. So just seeing how everything correlates and then how the government actually works and, how they can kind of essentially tax you without ever actually increasing taxes.
Right. It's the insidious hidden tax, the inflation tax. Absolutely. Very good point. So inflation is the insidious hidden tax, and it is kind of crazy that our government taxes us twice. Well, fundamentally they tax us twice, but in reality they tax us way more than twice. But that's kind of another discussion. The discussion here just about the inflation tax is very interesting. Inflation is thought of mostly as a monetary phenomenon. And Milton Friedman was one of the big people that promulgated that idea that, when you create more money, obviously, the value of anything is pretty much based on its rarity. So something that isn't rare has less value than something that is rare. If you print more, and I shouldn't even say money, I should say currency, because that's really what it is. If you print more currency, then the value of all currency in existence goes down because it is simply less rare, right? We all know that diamonds are much more rare than sand on the beach. There's lots of sand. It's very cheap. Diamonds, there's not that many of them, so they're very expensive. And the same applies to currency. Why wouldn't it, right? It's the same supply and demand laws that apply to everything. So, Jason, what is your view of the future? Do you think the future will be inflationary or not?
Absolutely. I see almost impossible where it's not inflationary, simply because the massive amount of debt the government is continuing to amass. And they really only have two options. One is raise taxes, which even if you're on the left or the right, is typically not very well looked upon with voters. So that de-incentivizes voters to give you a vote. And very few politicians are actually incentivized to increase taxes substantially, especially on the middle class and the working class, where the majority of their votes are coming from. So if they can't raise taxes, they have to print money. And the only way to pay off the debt is to print money, so you get inflation. And I really don't see any other solution out of this in the future.
No, I agree with you. Really, there are a few more options than just raising taxes or inflating away the government's obligations. But what I really like about my own investing strategy, frankly, I'll just say I like my own strategy the best, is that it aligns the investor's interest with these very powerful forces. I mean, look, we can complain about it as much as we want, but we're not going to change it, right? So,
Absolutely.
so this is the business plan for governments and central banks. Every country does it. Every country has done it for eons. It's just going to continue. It is very likely that it will happen because it's a great deal. They can just inflate their way out of the debt. But the 6 ways I came up with of, how the government could solve their problems, right? We all know the government is essentially insolvent. So it can either default on its obligations and stop paying them, not pay Social Security, not pay Medicare, not pay for all the entitlement programs, not pay its debt that it owes to foreign countries. This is totally unpalatable, right? It's never going to happen because there would be, riots in the streets. It could raise taxes, like you talked about. But really, I've seen the math on this. And Jason, it's mind-boggling. The problem is so large at this point that you literally couldn't raise taxes enough to pay for it. And of course, it's been proven over and over that raising taxes simply decreases economic activity. So you ultimately, kill the golden goose, right? So raising taxes is definitely not a solution. I mean, the folks on the left would say it is, but there's just not enough taxes to get to solve the problem. So that's not going to happen. We could sell off assets, right? The country has assets. It could sell, it could sell the ports to Dubai, like that came up in the news years ago, right? And we all remember the debate, sell military equipment to foreign countries and so forth. We could steal, right? We could use our military to take property from other countries. So those are all pretty negative, don't you think?
Absolutely.
Yeah.
If we start resorting to those things, we have a serious problem.
Yeah, right. Absolutely. On the positive side, there is one very positive thing that could happen is just technological innovation that would grow the economy, that would grow us out of the mess, right? I guess that's possible. It's kind of hard to fathom that innovation that would cause that growth would have to be America-centric. It would have to happen here for, if we're just viewing it from a U.S. perspective. And it would have to be pretty incredible, right? It would have to be some major discovery because the problem is so big that, I don't know, it would have to be some major discovery that we could export to the rest of the world and, would just sort of solve everybody's problems. But the most likely thing, as you say, is just inflate our way out. And so
Absolutely.
That begs the question of the discussion of the time value of money. So talk to us a little bit about the time value of money.
Absolutely. So the time value of money works in basically 2 sides. One is the money you have today is going to be worth less in the future because of inflation. And the second side is if you have money now and you invest it above the rate of inflation, then that money invested today can be worth more in the future in terms of actual dollar amount. So when you look at those 2 sides of it, it really makes real estate an incredible opportunity.
Yeah, you've got to beat inflation. You must beat inflation and taxes. Frankly, you got to beat them both. You got to beat both types of taxes. So the easy example is to just look at a bank account. And if the bank account pays, say you've got a long-term CD, right, that pays you a whopping 2%. If inflation is 2% and the CD is paying 2%, you're even with inflation. But the problem is now you got taxes. And so taxes will probably take away about 40% of that. So now you're just over 1%. You're losing money. You're just getting beat up by saving money. So that's not very fair, is it?
Right. I mean, you're losing value.
Yeah.
What you have today, you cannot trade for the same amount of goods as you could have in the past.
Right. Yeah. Okay. So how do you see, look, you've listened to like 1 episode of my podcast, right? So you're not indoctrinated with my thinking. It's great because, you're not prejudiced. You haven't been influenced by my thinking at all. How do you see this playing out and why do you like income property to solve this problem?
Well, as we already discussed, we see inflation continue to grow. So you can use it into your advantage with real estate and, of course, other types of leveraged assets, not just real estate. But I do know your show is more focused on the real estate side.
Right.
So first, by having cash flow, I think that's the most critical aspect of this equation. If you don't own an asset that cash flows, you're playing the speculation game, and that's a very hard game to win.
Mm-hmm. Yeah, folks, he intuitively is referring right there to commandment number 5, thou shalt not gamble. So good. I love it. Yeah.
Absolutely. I mean, that's true across all types of assets, whether it's real estate or business investing or even equities. If you don't have cash flow, you're speculating. The really nice part about real estate, though, is because there's so many incentives in government backing for the banks to give you these incredible loans. I mean, very low interest rates. I think they've actually recently started to creep back down again. And a large sum of money, as long as you can show the debt to income ratios up front. So this allows you to take the money, invest it into an asset that's cash flowing at above the interest rate and the inflation rate. So you're net positive. And the value of the loan that you take is going to be worth less by the time you actually pay it off. Plus, those monthly payments are going to be worth less by the time you actually pay it off as well.
Yeah. When and where did you learn this? Where did you come up with this idea? It wasn't from me.
No, it was not. I've been interested in investing for a very long time. I started investing back when I was in high school many years ago. And then our mutual friend, Daniel Moran.
Right. Well, not that many years ago. I mean, you're a young guy. I don't know if you want to say your age. You will feel free if you want.
15 years ago still.
Yeah. Okay. All right. And then Ryan Moran, our mutual friend. Yeah.
Yeah. I mean, Ryan talks a lot about this stuff. And then just being involved in seeing the effects of not understanding these things. So when I first got into investing, I used to play the speculation game. I used to think, if you just buy Apple today or whatever stock today, and hopefully go up. And sometimes it worked out great, and then sometimes I lost quite a bit of money. Mm-hmm. And it's like, okay, well, I'm losing money and I can't hold throughout this because there's no cash flow. And then I'm also realizing that with inflation, the value of my asset is going down. Not only did I lose money because I speculated incorrectly, the value of the money that I lost is also down as well. Mm-hmm. So it's just like a double hit, and all of a sudden light bulbs go off, and it's like, okay, well, I need an asset that is going to cash flow so I can hold through any dips in the asset value. And I need something that I can leverage inflation to my favor. So by borrowing against or using leverage, whether it's in business, I do this with my business as well. We take loans to fund essentially investments. Purchasing inventory is an investment for my company because I know that I'm going to be able to sell it and get a higher return on that investment.
Right.
In a business, you're talking 200-300% versus more passive incomes.
Mm-hmm.
But still, understanding the power of that leverage and allowing you to allocate resources, someone else's resources, for your personal benefit.
Sure. See, the thing about leverage is that you've got to have a way to maintain the leverage. And leverage is great, but not by itself, right? Leverage will kill you if it's not offset with income to service the debt of that leverage. And that's the beauty of income property. You can basically outsource the obligation for that debt to someone called a tenant. We're into outsourcing over here. Outsourcing is a wonderful thing, especially when you can outsource debt. That's a great deal. It makes it all sustainable. I call it sustainable investing because it allows you to stay in the game. We recommend investing in these linear markets that are nice and smooth markets. They have minor ups and downs, not significant ones. You can really stay in the game nicely with those markets because they have very good cash flow. But even if you don't listen to my advice, and if you invest in the cyclical markets with bad cash flow, with big, ugly, big glorious highs and big and terrible, ugly lows in the market cycle in terms of price, if you can manage to stay in the game, real estate is a game of staying power. You're going to win. The problem is in those markets with those big cycles, the cyclical markets that I don't recommend, most people can't afford to stay in the game. It's just too difficult because you'll be forced out. The cash flow is so bad, it'll just force you out of the market. That's really one of the key elements, isn't it? Is just staying power, right? The ability to stay in the game.
Absolutely.
Yeah.
Because when you average it out over time, almost all assets typically go up over time, any major asset class. Mm-hmm. The other thing, of course, that you started hitting on as well is risk versus reward. So some people are more risk advantageous,
yep,
and others, are less risk advantageous.
They might be risk averse or willing to take big risk, and usually that's dictated by age and the level of wealth that someone has. So yeah. So what about that? What were you going to say about it, though?
So I think that comes into a big play with real estate as well, because real estate is going to be predictable and it's going to be much lower risk as long as you are investing in those more stable markets. Mm-hmm. If you're investing in the higher risk markets, then of course you're taking on a higher risk, but you're looking for those higher reward numbers. Mm-hmm. But the beauty of real estate is it's a limited quantity. The U.S. can't, well, like technically we could take over new countries, but within the current confines of our current country, there's only a certain amount of land and a certain amount of areas and a certain amount of real estate available to either purchase, rent, or build on. And because of that, you're reducing a lot of your risk with all these other advantages, plus the cash flow, plus using the banks for your leverage. So it's really incredible.
Absolutely. Very good. Very good. Okay. So here's something I want to wrap up with is this concept. And it actually has a name now. I was doing it many years ago when I was 20. I started doing it when I was 21 or 22 years old. I bought my first rental property at 20. I did not do this technique then. That was a traditional rental property purchase. Okay. But the term, it actually has a term nowadays. It's called house hacking. House hacking. And if you haven't heard that term, let me just explain to our listeners what it means, because I know you've got some plans with that, Jason. So we'll share your ideas with our listeners. Here's what house hacking is. It's really a concept designed for someone who lives in a good, solid, linear real estate market already and who's just getting started, who doesn't have much money to invest with, right? This can be the perfect fit for that person. And basically what it is it just means you use an owner-occupied loan to get into the house and you live in it for a year or two. And, that's okay, because as long as you intend to live there and you really do move in, you're okay. And the owner-occupied loans are much more desirable. And so what you do is you basically do a plan over several years, and this gets you started. You get a very low down payment loan. If you're a veteran, Jason, like you are, you get a VA loan. And this can be a very attractive opportunity. And you can also get this on a plex, right? It could be a duplex, a triplex, a fourplex, anything up to 4 units, and you live in one of the units, and you've still got that very, very desirable loan. Talk to us about that, if you would.
Absolutely. It's an incredible opportunity, especially for veterans or active duty military. One stipulation that I don't think gets talked about enough as well is if you're on active duty orders and you get ordered somewhere else, you don't have to maintain that full year in the home to keep the VA loan.
Right. Same with leases. And that I'll give you, just to go on a little tangent, we love military tenants. There's only one downside to them, is that if they get orders to deploy, they can break their lease. So same idea. Yeah. Okay, good. Yeah. So you can move. So what does that mean though? Like, what would that mean to an active duty person?
So the real advantage is not having to put that down payment down, right? Because that's more cash that you can invest in other areas and a larger leverage. Now, the risk here is if you do have a market dip and you do have to sell for some reason, you don't have any equity going into the home initially. So that is the increased risk on this type of strategy. Mm-hmm. But if you're playing for the long term, like you should be, and you're purchasing in order to either rent it out immediately or eventually, and when I say immediately, I'm talking about a duplex, triplex, or quadplex, because you could rent 2 to 3 of those other units and live in one of them, then this becomes extremely advantageous because you have no initial personal investment. So you're basically getting a free cash flowing real estate asset. Mm-hmm. I mean, It's an incredible deal for people who can take advantage of it.
It is an incredible deal. Just make sure, folks, you must move in to the property and you must live there. Okay, you must actually do that. Okay, so this is really a good strategy for a person getting started. You're doing it with the mind of an investor, but you got to actually move in and, follow the rules that are required by owner-occupied loans. You can get that advantageous loan, live there for a couple of years, and then buy another property and live there for a couple of years and house hack again. You probably won't need to, because by then you'll probably have some money. But it's a great tool for someone just starting out. Isn't this awesome?
Yeah. And I think you can always be used because you have to live somewhere no matter what. Mm-hmm. So maybe you continue to buy another income property, but your next house that you're going to live in, you can now use the VA loan again, or you can refinance the previous loan that you had back to a traditional loan since you already have equity built in now. Do a new VA loan so you're not putting any of your own money up front on the house you actually want to live in. And then instead of having that money wasted on the home you want to live in, you can use that to purchase another income property for your 20% or 10% down payment. So it's advantageous, not even if it's not just your first home purchase.
Good stuff. That's really good. Okay, great. Well, Jason, thank you for joining us today. It's just nice to get fresh insights from someone who, is thinking on the same track like we are, myself and my listeners. It's just really refreshing to hear this stuff. So glad you're on the right track, and I just want to wish you a great future and happy investing.
Thank you, Jason.
Yep, my pleasure. Hey, one more thing. Do you want to give out a website for your business or anything like that? You're welcome to.
Sure. If you want to check out, if you're into fitness at all, we sell quite a few different types of fitness gear. Our website is element26.co.
Element26.co, and you can get the products on Amazon as well, right?
Yep, exactly.
Fantastic. Thanks for joining us.
Thanks, Jason. Appreciate it.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.